When the system's analysts start whispering about yield curve inversions, most people's attention drifts. They dismiss it as just another complex economic term, detached from their personal financial reality. But here is the structural logic they consistently ignore. Every time this code emerges, it signals an inevitable convergence of debt cycles beneath the financial surface. And the current structural context suggests a value readjustment that possesses a greater scope than the leverage seen during the panic of 1873, and which makes 2008 appear as merely a system stress test. The inversion logic has preceded every major financial reckoning for the past 50 years. Not most of them, not nearly all of them, every single one. The structural logic of collapse is rarely advertised by a flashing red sign on Wall Street. Instead, it arrives through a technical indicator so dull and abstract that most people's eyes glaze over the moment the term is uttered. But pay attention, because the inversion of the yield curve is the financial system's oldest, most reliable, and most cynical alarm. It is a mass panic disguised as a data point. When the cost of borrowing short-term money rises above the expected return on long-term government debt, the natural order of capital flips upside down. Why should a lender accept less yield to park their capital for 30 years than they would for 2 years? Because they are terrified of the near-term future. They are willing to pay the government a premium for safety, believing the alternatives, corporate bonds, stocks, real estate, are guaranteed to collapse. This flight to long-term safety is not guesswork. It is the collective data-driven judgment of the largest institutions that the system is unstable. This is not a historical anomaly. This is a recurring, lethal pattern of imperial overstretch. Examine the fall of the Roman Republic. As chronicled by historians of ancient economics, the collapse wasn't a single event, but the culmination of perpetual state expansion and the corruption of the currency. The debasement of the denarius under emperors like Commodus was the ancient world's version of quantitative easing, confirming the pattern of imperial overstretch. The state, attempting to maintain the illusion of abundance, destroyed the actual mechanism of trust. This structural decline is always masked by temporary prosperity. In the 1920s, the yield curve inverted in 1928. This warning was ignored, buried beneath the narrative of perpetual prosperity fueled by speculative margin debt. John Kenneth Galbraith's detailed analysis in The Great Crash, 1929, meticulously outlines this period of profound moral hazard, where the Federal Reserve, tightening policy to cool a debt-fueled economy, triggered the structural consequence exactly 18 months after the inversion. The state did not step in to save the day. The state's structure of credit enablement caused the systemic breakdown. The fraudulent structural design is this. The system is engineered to incentivize reckless speculation because the state guarantees the downside. In 2006, the curve inverted again. The system was drowning in opaque, repackaged subprime mortgage debt. Banks knew they were creating bad paper, but they didn't care because the master plan allowed them to package the risk and sell it on, transferring the time bomb to the global investor base. This is the structural logic of collapse. It is an optimized engine for debt monetization and risk transfer, socializing the losses while privatizing the gains. The crisis that followed, detailed in the Financial Crisis Inquiry Commission report, 2011, was not an accident. It was the inevitable consequence of a system designed to chase unsustainable leverage. Every single time, the inversion flashes its warning. 1928, 2006, and now, today. The agenda of perpetual deferral has now reached its terminal phase. After 2008, the state, via the central bank, invented a new playbook to avoid the structural reckoning. They did not solve the debt problem, they multiplied it. They suppressed interest rates to near zero for over a decade and printed trillions of dollars under the guise of stimulating the economy. This wasn't a solution. It was an attempt to delay the inevitable reckoning by inflating asset prices, houses, stocks, and even cryptocurrencies, which created the new, critical vulnerabilities. You were told this was a recovery. It was, in fact, the imposition of chronic monetary addiction. The patient was stabilized not by healing, but by an infusion of the poison that caused the original disease. Today, we are watching the third act of this tragedy unfold. The latest inversion is occurring in an environment where the foundational economic parameters have been irreparably distorted. In previous crises, central banks had the structural room to maneuver. They could cut rates dramatically, or they could engage in massive government spending without triggering immediate, catastrophic inflation. They are out of ammunition. The debt levels, government, corporate, and household, are so immense, they can no longer be accurately comprehended. The total U.S. national debt, coupled with unfunded liabilities, ensures that the numbers have crossed the threshold of meaningful repayment. This is where the structural integrity fails, and the illusion of sovereign control evaporates. The financial architects convinced themselves they could engineer perpetual prosperity by manipulating the price of money. They made borrowing essentially free and saving pointless. What was the consequence? An economy addicted to life support, a corporate structure that prioritized share buybacks and financial engineering over productive investment, and a housing market that became a speculative investment vehicle rather than shelter. The economy cannot now tolerate the natural cost of capital, and the inversion is the market's response to the Fed's fatal mistake, raising rates to fight the inflation caused by their own prior printing. The market is screaming that the corporate debt, the commercial real estate debt, and the leveraged fantasy of the last decade cannot survive honest interest rates. And for the professional who feels exhausted and trapped, the financial leash is tighter than you realize. Your low savings return, your inflated home price, your job at a company that optimized for cheap debt rather than actual business sovereignty. All of it is predicated on the continuation of the lie. The system is now so complex, linked by derivatives, algorithmic trading, and international currency swaps, that a failure in one obscure sector, say, the refinancing wall of commercial debt rolling over in 2025 through 2027, will cascade through pathways that did not even exist in 2008. The failure is not localized, it is systemic. The powers that be, the ones you suspect are holding the string, will attempt to stop the consequence. They have to. But their tools are dull, and their leverage is spent. Their past interventions were deferrals, not solutions, and the structural integrity of the system is weaker now than it was in 1929 or 2008. The current danger is compounded by the historical truth that the antidotes are now the poison. The failure is not market sentiment, it is physics. The central bank's toolkit for fighting the last war has been emptied and repurposed for the next crisis, leaving them structurally blind. They cannot cut rates dramatically, nor can they return to open-ended quantitative easing without shattering the final threads of currency confidence. The primary conventional weapon, cutting the Fed funds rate, is functionally gone. After 2008, rates were held near zero for so long that the effective floor was reached. Future cuts, even if initiated, will be a fraction of the historical response, e.g., the massive cuts of 2001 or 2008, rendering the response insufficient for a crisis of this structural depth. The quantitative easing paradox, QE, the large-scale purchase of assets, was a success in preventing liquidity collapse, but a failure in restoring genuine, organic growth. Its function was not to create productive investment, but to inflate asset prices to make the banking system look solvent. The Bank for International Settlements, BIS, has documented that this unconventional policy, while effective in short-term stabilization, resulted in major side effects, namely, disincentivizing private sector deleveraging and encouraging global debt accumulation. The structural lesson is that QE did not heal the patient. It created a chronic dependency on the central bank's balance sheet. The negative interest rate. Fiction. NIRP. The deployment of NIRP in countries like Japan and parts of Europe proves that financial repression has limits. Pushing rates below zero destroyed the economic function of saving and punished the prudent. Yet it failed to generate the desired velocity of money. It simply validated the market's terror and demonstrated the central bank's desperation. This political tool, masquerading as economic policy, is a dead end. They have sacrificed the utility of their weapons for temporary political calm. You have to ask the fundamental question that the system tries to obscure: what is the dollar? It is a piece of paper, a digital ledger entry, whose value is maintained purely by collective belief and the state's decree. The U.S. Code, specifically 31 U.S. Code 5103, states that U.S. coins and currency are legal tender for all debts, public charges, taxes, and dues. This foundational document confirms the cynical design. The dollar's value is maintained by the legal obligation to settle debts, not by a claim on tangible assets. The sovereignty of debt. The dollar is not backed by gold or productive capacity. It is backed by the promise of future taxation and the obligation of the Federal Reserve's balance sheet, meaning more debt. This is the ultimate illusion of sovereign control. The financial code reveals the currency's weakness. It is not a store of value. It is a claim on future debt issuance. The global export of inflation, the dollar's role as the global reserve currency, an inheritance, not an earned status, means that the Fed's debasement is exported. When they print to solve an internal problem, they impose inflation and economic turbulence on countries that are heavily indebted in dollars. This structural asymmetry ensures that the final consequence will not be an American-only event. It will be a coordinated implosion of the global debt stack. The Latin American debt crisis of the 1980s, triggered by tight U.S. monetary policy and soaring dollar strength, serves as the most brutal recent precedent, a lost decade for entire nations, because one central bank decided its domestic priorities superseded global stability. They are merely a global clearinghouse for liabilities. The yield curve inversion is the alarm, but the refinancing wall is the immediate physical mechanism of structural consequence. Corporate America, convinced the cheap money era was permanent, took on historic levels of debt to fund everything from stock buybacks to acquisitions, not to build factories or hire workers. This debt must now be rolled over. The scale of the cliff, from 2025 to 2027, an unprecedented volume of corporate and commercial real estate, CRE, debt is set to mature. Debt issued when rates were near zero. High-yield issuers, the weakest links in the chain, face the stark reality of refinancing their obligations at interest rates that are often 150 to 200 basis points higher than their original coupons. The commercial real estate domino, specifically, the CRE loan maturity wall is nearing $1 trillion in 2025 alone, compounded by historically high office vacancy rates. Banks are exposed. When these loans reset, the value of the underlying assets cannot support the new debt service costs. This is not a cyclical downturn. It is a structural collapse of an entire asset class. As these loans default, they force banks to set aside massive provisions for losses, restricting the supply of credit to the rest of the economy, the classic self-fulfilling prophecy of a financial panic. The algorithmic acceleration in 1929, panic took days to cross the country. In 2008, it took hours to cross the globe. Today, algorithmic trading systems amplify and execute panic at the speed of light. An immediate liquidity failure in a major derivatives market or a significant corporate default will trigger a chain reaction executed by machines that have no moral compass, no memory, and no patience. They will not wait for a Fed announcement. They will liquidate. This is the point where most analysts offer generic panic or cheap motivation. I offer strategy. You do not need to fear the event. You need to recognize it as a strategic opportunity, a necessary value readjustment that purges the malinvestments and clears the board. For the prepared, volatility is not the enemy, it is the ally of the strategist. Panic is a structural choice, not an emotion. The exhausted masses cling to the lie that the system will be saved. This belief, however, is your greatest strategic advantage because it guarantees the unprepared will be forced into desperate liquidation exactly when the strategist needs to acquire assets. The certainty of liquidation, the consequence is not merely destruction. It is a process of forced liquidation of malinvestment. The system must clear the debt that cannot be serviced. The assets that plummet in value, stocks, leveraged real estate, exotic bonds, are precisely those that were artificially inflated by the Fed's cheap money. The strategist understands that the market must drop by 40, 50, or 60% to simply return to a genuine, non-debt inflated value. This is the repricing event, and it is essential. The structural opportunity, the moment of maximum pain, is the moment when wealth transfers. It transfers from the highly leveraged to the sovereign few who maintained minimal dependency. Your goal is not to preserve inflated paper wealth, but to position your capital to acquire real productive assets at the prices of desperation. The crisis phase is the ultimate test of patience and non-emotional analysis. Your goal is to acquire, not to cling. Your only reliable defense, your master plan for this inevitable confrontation, is not guessing the market's next move, but achieving intellectual resistance and structural independence. This is the discipline of minimal dependency. Austerity as sovereignty, this is the non-negotiable core of the master plan. Critique the structural reliance on debt, mortgages, corporate borrowing, student loans, as a willing forfeiture of personal sovereignty. Every dollar you borrow, for a car, for a second property, or for education that lacks economic utility, is a forfeiture of your future negotiating power. It is a financial leash that the system can tug during the crisis. The real asset filter, true real assets, are those that possess utility independent of central bank manipulation. This includes skills, time, physical land, productive equipment, and unencumbered capital, cash, gold, Bitcoin. If the asset's value rests solely on the availability of cheap credit, it is a liability in waiting. The unlevered life, the single most crucial metric for a strategist, is the liquidity of your liabilities. The system's leverage is your weakness. The man with zero debt and a secure portable skill set has more optionality and real wealth than the highly leveraged millionaire whose paper empire rests on the continuation of the Fed's lies. When the crash comes and the leveraged majority is forced to liquidate everything, the unlevered life is the one that steps in to acquire those assets at a steep discount. The leverage is always on the other side of the contract. Stoicism is the process of optimizing for non-financial failure, meaning position yourself where a financial market implosion does not automatically trigger your personal bankruptcy. This is the ultimate intellectual resistance against the illusion of abundance. Control the input, ignore the outcome. The strategist focuses exclusively on what they can control: savings rate, debt elimination, skill development, and location. You cannot control the Fed AS policy or the exact timing of the inversion AS payoff, so you must ignore the hype. The test of time. History is replete with examples where those who remained solvent during the panic were the inheritors of the new system. The Panic of 1873 in the United States, followed by the Long Depression, destroyed railroads and speculative banks, but it positioned those holding cash and liquid capital to rebuild and control the infrastructure of the next century. This pattern is immutable. The strategist prepares for a multi-year economic winter, where the scarcity of credit, not money, is the dominant force. This structural design for resistance is your personal defense mechanism against the shattering of the social contract. The moment the exhausted masses realized the promise of work hard, save money, and trust the system was a fiction. The strategist does not panic, the strategist prepares for the opportunity phase. The yield curve has already screamed its final warning. The system is out of tools. The moment of reckoning is no longer a possibility. It is a mathematical certainty embedded in the financial code. The master plan is simply to ensure that when the system breaks, you are on the list of those who collect the pieces, not those who are liquidated by them. The choice is not complicated. It is a choice of allegiance. Will you remain tied to the fiction of abundance, or will you achieve the sovereignty that only absolute minimal dependency can provide? The time for hope is over. The time for strategy is now. This video is merely the diagnosis. The true work lies in the execution of the strategy. You need to know the next move in the code, the structural design of liquidity crisis. That is the essential next step in the master plan. Join the few who chose to see the structure. I'll wait for you here with the strategy.